Many people have had this experience. They see positive news, excitedly jump in to go long, but the price ends up falling. They see negative news, quickly go short, but the price rebounds and rises. Repeatedly, they end up chasing highs and selling lows. Why? Because institutions and retail investors operate on completely different trading logics. Institutions trade on expectations, while retail investors trade on the news. What does trading on expectations mean? It means positioning before the news is even released, based on various information that suggests what the news might contain. Take the non-farm payroll data as an example. Institutions may start positioning as early as 2 weeks before the data release. They assess clues from Fed officials' speeches, other employment data, market expectations, and so on to determine that the non-farm data is likely to beat expectations, so they go long on the dollar in advance. When the news is released, if it matches expectations, the price barely moves because the market has already priced it in. At that point, institutions will take profits by reducing their positions. What does trading on the news mean? It means waiting until after the news is released, reading its content, forming a directional view based on its surface, meaning, and then immediately entering the market. But by then, the price has already moved significantly. When retail investors see that non-farm data is better than expected, they assume it's bullish for the dollar and immediately go long. But at that same moment, institutions are reducing positions to lock in profits. This is why the good news that retail investors see is often followed by a price drop. Information asymmetry is the core advantage of institutions. They have professional information channels, research teams, and data analysis capabilities that allow them to access and interpret information earlier and more accurately. Retail investors, on the other hand, can only obtain information from public news sources, and it is often delayed. Speed of reaction is another advantage. Institutions have millisecond-level high-frequency trading systems that can execute trades the instant information is released. Retail investors need to manually read the news, assess the direction, and place orders, a process that can take minutes. In the forex market, price movements over a few minutes may have already completed the entire trend. But retail investors are not entirely without opportunity. The key is to shift from chasing the market to positioning in advance. How do you position in advance? Pay attention to central bank forward guidance, analyze market expectations, track related economic data, and understand policy trends. When you have your own judgment before the news is released, you will no longer blindly chase rallies or sell-offs after the news comes out. Are you chasing the market or positioning in advance?